Morning and welcome back, everyone, to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at Options Play, and we are starting off this week very much in the same place we were for the last few weeks with regards to the S&P 500. There's been a bit more in terms of tremors within the negotiations of trade wars over the last week or so that's led equities to pause the significant rally that we've seen here since the beginning of April. We're talking about nearly a 25% rally we've seen here in the last 2 months in the equity markets, and that rally has paused here over the last few weeks as we sort of digest what more optimism is there left? Because I would say a lot of the optimism with regards to the trade wars have already been priced into the market. And as we as we close out an earnings season this month and see that some of the trade war negotiations from the last few weeks have started to um, uh, fall back a little bit. There's a little bit concern here from the equity markets as to, whether or not we have enough momentum to retest these all-time highs. Not to mention, there's a lot more chatter right now with regards to the bond markets and whether or not, the bond investors are starting to get a little bit more concerned with regards to the debt load here for the U.S. Treasury market. So these are all things that at the moment are providing a little bit more of an upside cap to the S&P 500. I do think that there's a more elevated chance here of a pullback here in the short run. We have a gap fill here around 5,700. That could be a small short-term downside target here for just a bit of consolidation, a little bit of a pullback here after what has been one of the strongest rallies here in the S&P 500 over the last 20 plus years. You look at the NASDAQ 100, we're also within spitting distance of the all-time highs, very close to getting there, and we very well could get there. But like I said, there's a lot more concern that I see here in the markets here over the last couple of weeks that have started to build up here. That is, in my opinion, in the short run, going to limit the upside potential here for some of these equity indices. Note that the Russell 2000, the small cap indice, has not really gotten back above that 210 double top level here, which leads us to believe that there's further downside here for small caps. And then you look at equal weight S&P 500, still not quite near recent all-time highs. You have this double top at 182 that is likely going to act as some short-term resistance here. But note that the equal weight S&P 500 index has been underperforming the market cap weighted by a pretty significant margin here over the last few months. Last few weeks relative to the market cap weighted index, and that's just suggesting that the broader market here is not really keeping up with the equity rally that we've seen over the past few weeks. That it's more of the mega cap names that are sort of dragging the markets higher here. So you're seeing a little bit of a dislocation here between the rest of the market with the call it the Mag 7 or the mega cap growth names that have been dragging the markets higher here. And that is always a bit of a concern when we see that. So we would really like to see the rest of the market play a little bit of catch up in order to have more confidence in the markets to retest those all-time highs. If instead this continues, this dislocation or this bifurcation between the rest of the market and the mega cap names, then you have a bigger risk of a pullback here for equities. So those are some of the things we're paying attention to right now from a macro perspective. Commodities have continued to moderate here with gold reaching kind of back to those all-time highs on the back of kind of safe haven demand. One interesting thing to see is that, the high yield corporate bond market right now is still at those 52-week highs. That really suggests that the riskier end of the curve from a bond investing perspective at the moment is not too overly concerned with credit risk and actually continues to signal on a risk on environment that we're currently in. And that has largely provided the momentum for equities to stay near these recent highs and potentially push back towards those all-time highs. But this is one indicator that I'm paying very close attention to for any signs of, as Jamie Dimon calls it, cracks that might show up here in the bond markets here. A lot of eyeballs are currently on the bond markets with the 20 and 30-year yields approaching 5% again. These are levels that, as we are thinking about lowering interest rates, we should really be seeing these rates at a lower level at the moment. But the fact that that the longer dated bonds are trading at those specific levels really speaks to more of a concern, a little bit of stress that's starting to show up here in the prices of longer dated bonds. So those are some of the most important things I think worth paying attention to here right now, with the VIX currently trading at 18%. It really feels like the market is sort of underpricing some tail risk right now, whether that's tail risk coming in from headline news with regards to trade wars, or we've seen kind of poor treasury auctions be one of the catalysts for sell-offs. VIX at 18% really feels like it's a little bit underpricing some of that tail risk right now, which does provide an opportunity for option buyers at the moment. See the 10-year yield currently still trading around 4.4%. 20-year yields, and 20 and 30 years are still above 5% here. And look at TLT, very much near the 52-week low. So this 83.5 level, I think, is really worth paying attention to, because if we test those levels and break lower, that really sends yields higher here, and that's a concern overall. We continue to see the dollar kind of retest this $99 level here, and 98 is kind of the potential double bottom here that we're really looking for as for the dollar to bounce off of this. But if we break below 98, that would be quite bearish here for the dollar overall. Gold, as you can see, recently rallied up, towards those 3,400 with the 3,500 as the all-time high. This is really on the back of demand for safe havens as the markets have kind of been a lot more concerned with regards to trade wars. We've seen oil kind of pick up a little bit here off those lows, trading around 62.5. And then looking at the individual sectors here at the moment, we really have seen a lack of rotation here. Largely, technology has been the driver of the markets here over the last 2 months since the April lows. Consumer discretionary has also come off the lows a little bit here, starting to show a little bit of outperformance over the last few months. Minor outperformance, but outperformance nonetheless. And industrials. Industrials was the other sector that has recently continued to outperform the S&P 500. So, those are the three sectors that largely have been outperforming and continue to outperform. We really haven't seen any new sectors come, to life in the last few weeks. So we're seeing a bit of a lack of rotation here. On the flip side, you have sectors like healthcare that have really taken a huge hit here since those April lows, basically very much trading near the April lows. You have materials also starting to underperform the S&P 500 here as well, after what was a decent start to the year in terms of some slight outperformance, giving all of that back here over the last couple of weeks. And then if you look at real estate as well, we've seen real estate collapse a bit over the past few weeks since those April lows, really not keeping up here with the recovery, and that largely can be due to the rising yields at the moment, as well as energy prices, or energy stocks rather, collapsing here as well relative to the decline we've seen here in oil prices. So Like I said, the sectors that have outperformed continue to outperform. The sectors that have underperformed have continued to underperform pretty much since the April the lows that we saw here at the beginning of April. So over the next couple of weeks, I would really like to see a little bit more rotation in order to have a little bit more confidence in the equity markets that they will retest all-time highs and potentially break out higher. Otherwise, if we see the lack of rotation, that is going to further uh, the thesis that we have a higher likelihood of a pullback here, short-term pullback into the 5,700 level here on the S&P 500. So from a macro perspective, that is largely where we stand. Not a lot has changed here over the last week or so, and this week, probably the most important thing to pay attention to right now are non-farm payrolls that come out on Friday. That's going to give us a clear understanding of how strong the labor market is. And that's going to be a major input here for the Federal Reserve in terms of their decision to cut rates. The Fed has been very clear in terms of their desire to be more patient with cutting rates. While I think quite a few market participants right now are hoping that the Fed can cut rates lower to kind of stimulate the economy a little bit. That clearly has slowed down over the last few months as trade wars have escalated, as just the overall appetite for consumer spending has clearly declined here in 2025 with higher interest rates, and that's something that um, for a lot of traders, they're looking for, perhaps a slightly weaker jobs number that would give the Fed the data that they need to move and potentially lower rates. Otherwise, another strong report would just solidify their decision to kind of keep rates higher for longer to ensure that inflation doesn't pick up. They cut rates here again. So like I said, that's kind of where we stand here from a macro picture perspective. Looking at the ideas here for the week, some of the ones that I think are worth paying attention to here right now. There's a couple of big names that I think are worth taking a look at. First one is Microsoft. Microsoft recently is trading at around 30 times forward earnings. It's just around this double top here at 465. Looks like it's just on the verge of potentially breaking out here. And notice that over the last couple of months, it's significantly outperformed the S&P 500 over the last couple of months. Yet it trades at only 30 times forward earnings, which is a slight premium to its peer group. But if you look at kind of top and bottom line growth, they're expected to exceed their peers by a good margin here. But more importantly, net margins for the stock is north of 35%, which is head and shoulders above the industry median of around 10%. So, for every dollar they generate in revenue, they're earning 35 cents in net income. That is just far more profitable than most tech stocks and most stocks in the S&P 500. So for those reasons, the fact that it trades, at only 30 times forward earnings, I think is still inexpensive and has some further upside potential here as it approaches this major technical level on a potential breakout. The next one I want to take a look at here is Oracle. Oracle recently, as you can see from a trade setup perspective, and this is a chart setup that we like a lot, where it's a stock that has underperformed for a period, has kind of started to break out here, came back to retest as support, and has the potential to continue higher into that 190 level here. Oracle trades at a discount to its peers at around 24 times forward earnings versus 27 for the industry, 27, 28 for the industry. It is expected to grow top and bottom line faster than its peers as well. And more importantly, it's more profitable than its peers. Net margins are around 22%. So for every dollar they earn in revenue, they're earning 22 cents in net income. So that's more than double what the industry standard or industry median is, around 10% net margins. So you have higher profitability, faster growth rates, yet it trades at a discount to its peers. That's what represents the upside potential here for Oracle. Another one that I want to take a look at here is Adobe. I've looked at Adobe for quite some time here. It did pull back here to this 400 level here. We'll see if that level holds, but that's our thesis, is that that holds and we trade up into the 465 upside target here for Adobe. Adobe, similar to Oracle, trades at a pretty significant discount to its industry. It's trading at only 20 times forward earnings versus 27 for the industry. It's not expected to grow as fast as Microsoft and Oracle, but it's just a little bit behind. I'm expecting to grow top line by about 10%, bottom line by about 12%, which is roughly in line with the industry. But net margins for Adobe are 31%. So for every $1 they earn in revenue, they're generating 31 cents in net profits versus, again, the 10% for the industry. Means that it's head and shoulders above the industry from a profitability perspective. Growth is very much in line with the industry, but when you factor those two things in together, the stock is trading at, what, a close to a 15 to 20% discount, or sorry, greater than that. It's trading at about a closer to 30% discount, not quite 30, 25% discount to the industry median, but it's expected to grow in line with the industry and it's far more profitable. This is really where I think the upside potential here for Adobe is quite significant when you look at those factors and those valuations. Yes, Adobe is the type of company that can very much be disrupted by AI, and that's been, what has driven the stock price lower here over the past year or so. But I think some of those concerns are slightly overblown, as Adobe's Firefly app, which is their AI model. They're one of the few companies out there that has an AI model that they're monetizing today. There's a lot of companies out there talking about AI, saying that they're going to have AI. Good example of that is Apple. There's a lot of talk saying that it's going to happen. Here's what you're going to get, and we get months and months and months of delays. Adobe has been selling an AI tool for well over a year now. Yet investors still have this concern that enterprise clients won't move over, that they're going to that Adobe's going to get disrupted by AI. And I just at the moment don't see that actually happening, given just how much the enterprise creative space relies on Adobe for almost all design work. Let's take a look at United Rentals. We've talked about industrials outperforming here. So United Rentals recently, as you can see, broke out here above the 660 level here. It's starting to come back to retest this level of support, consolidating a little bit, and that presents an opportunity for further upside here. Our upside target here is around 750. United Rentals trades at a discount to its peers, 16.5% versus 18 for the industry. So not a huge discount, but definitely a bit of a discount here. It's expected to grow top and bottom line very much in line with the industry. Top line around 5%, bottom line around 10%. But United Rentals, has net margins north of 16% versus the industry medians is a little over 9%. So, net margins are nearly double the industry standard, and it's expected to grow just as fast, yet it trades at about call it a 10 to 15% discount to its peers. So that's what represents the upside potential here from a valuation perspective. And I think the technical setup here from a timing perspective looks optimal to start adding some bullish exposure here for United Rentals. And then what I'll do is I'll take a look at some of our bearish opportunities here at the moment. The first one I want to take a look at here is International Paper. Paper company, in a world that's moving towards digital, I think this is the type of company that certainly has some downward pressure put on it here. It broke down below that $49.50 support resistance level. It's kind of retested it as resistance now and trading lower here. So, the first downside target is 43. If we can get below 43, we're looking at closer to about 40 is our full downside target here for IP. It trades at it trades at a premium relative to its peers. Now, it is expected to grow faster than its peers, but it's actually less profitable than its peers. And so for those reasons, I think the fact that it trades at 22 times forward earnings versus the industry is closer to 13, represents a stock that is very fully valued, if not overvalued, based on the prospects that we're currently seeing here for this industry. Apple is another one that I've maintained a bearish view here on for quite a few weeks. Essentially, every single time we get these rallies here, I think are opportunities to sell, and that's exactly what we've done recently here. Excuse me. Expecting potential downside target here as low as 170 here to the downside. Those were the April lows. That's what we're looking at. Apple trades at 28 times forward earnings versus 18 or 19 for the industry median. So we're talking about nearly 100% higher. I'm sorry, yeah, about 50% higher in terms of valuations versus its peers. Yet it's expected to grow actually slower than the industry. The only thing going for Apple are its net margins. It's got 24% net margins, and it's stayed there for quite some time, and that's really what's provided some of the catalyst for some potential downside exposure here for Apple. And I'll leave you with one last one, and that's T-Mobile. As you can see, T-Mobile has been trending lower here recently. It's trading at 22 times forward earnings versus the industry median's only 10 times forward earnings. It grows a little bit faster than the industry, but it's not any more profitable than the industry. And that's why I think there's some downside risks here for T-Mobile. So that's largely what we see here in the broader markets here right now. Like I said, the equity markets have rallied significantly. It's taken a bit of a pause. There are some downside risks that started to emerge here over the last few weeks that I think are worth paying attention to here right now. And these are ideas here for the week. With that, I hope that helps you kick off your week, and I'll see you here next week. Thank you so much.